we count a one, two, three, four, five structure,
Yeah.
but on a corrective wave, we're counting A, B, C move down.
When we
And
when we get to the third wave, then it's going up?
yep, so when this cycle ends, we're starting an entire new impulse wave.
Okay.
So this is a macro view. I mean, in terms of Elliott wave structure,
Yeah.
we completed this whole move, this one, two, three, four,
Yeah.
five. Now we're in our corrective wave of an A, B, C, and there's cycles to these. Like a grand super
Mhm.
cycle, cycle, primary. The count I have right now is just a primary.
Okay.
So we're in our primary wave. So there's still one last corrective wave that kind of needs to happen to show stability and price action before we can jump back into a new primary. I think
Okay.
there's a chart here.
So, Clutch, I sent you a DM. That's actually everything that the stonks guy got my dad to get into.
I'll
And
take
the
a look at
and
them.
these are all dividend stocks.
These are none I have in my portfolio.
Yeah, and he gets like he was telling me he pays for some software that lets him get like some like real crazy tracking and stuff. And then he's been in the he's a real old Jewish guy, and he's got
I love them.
yeah, and he's a
Those are my favorite guys to talk to.
he's a real cool guy. He tells me he subscribes to. I lost the paper, um, but it's this one guy, and it's like he said it's like a racker to like subscribe to this guy and get his calls and stuff.
There's
I
some really good play callers out there that
yeah
do a phenomenal job.
yeah,
Um, let me see if I can find it.
and then the one that he was telling me that he was really bullish on was ADMA. It's like a biology thing, and
ADMA. Um, I'm just gonna post this here, but I mean, this was like these were my like 2021 stocks that like I invested in at the beginning of. Well, a lot of these are rollover. Like I don't like to have more than like 25 stocks in like my portfolio at like any given time. Um, it's just one of my rules. Um, but a good way to determine what's a financially strong stock, we're going to be looking at cash flow. So, I mean, we're going to look at their net income. We're going to add back in their depreciation. If it's plus or minus, we're going to add back or subtract their working capital. And then we're going to add back their cash from others. It could be, investors or like, we're not looking for loans. Like, I want to make sure that this is actual income that's viable and sustainable for the company that was cash flow. So it
right.
could be like, receipts, things like that, like things that are on back order that they like, hey, like we're someone purchased 50,000 from them, but they're making installment payments. So it's not a loan on the company's part, but it's a loan on the person who purchased it from the company. And so this is how you can see what their cash from operations are. Because I'm not looking at a company's net income because let's face it, every company that's worth a grain of salt knows how to deduct their taxes and pay minimal income. So that's not a good number to go off of. I want to be looking at what's their cash from operations. How much money did these guys make just by being in business?
Yeah,
Um,
that's what the like his charting thing that he had. It was like trading view on
mm,
steroids, and it
I
shows
do
like
this shit manually.
yeah. So the chart that he has, it shows their Q1 through 4, how much like they bring in each year, and it was some crazy ass charting. I was like, okay, I was like, this guy definitely has. He's like not a lot of people are even allowed to have like this software and shit, and it was yeah. I'll ask him what the chart service was.
That'd be great. Because
Yeah.
what I do is I take a look at each sector. So, like, I want to make sure I'm invested at least in every single sector that's still strong, that has 5 years history of having a positive cash from operations trend. So that's what a financially strong company to me is. Over the last 5 years, your cash from operations has increased. It hasn't gone down.
So
And
what
so
what about IPOs, Clutch.
About what?
What IPO?
Those are speculative. So those don't go into my bedrock. So I mean, this is like
Okay.
my bedrock portfolio, and so this typically gets 60% of my entire portfolio. I want a mix of blue chips. I want a mix of growth stocks, a mix of value stocks, and then I will do, kind of like a toss up of like 20% could be like commodities, like like or silver, gold, those kinds of things. And then the other 10% is going to be speculative plays. So that's going to be like your Tesla, your Bitcoin, your Ethereum, your completely speculative plays that it's not a financially strong stock, but I really like the CEO, maybe I like the direction they're going, but I don't have enough data yet. So I'm going to mitigate my risk and go in with a much smaller position size versus having my bedrock receiving over 60 to 70% of my portfolio. And then I just redo
Okay.
this every year during January. And
Okay.
this is something I like learned from like my buddy's dad, who's a ex hedge fund manager. He said not to name him because I'm not supposed to actually know all this stuff, but solid dude and taught me a mountain of information. So grateful for it.
Mm.
I'm just gonna delete this because it's not part of today's lesson, but we can do it another day. So I mean, we'll give it up to like 5:05 my time, so like another 3 minutes, and we'll just start our recording from there and kick it off. People show up, awesome. If not, they'll watch the recording.
Oh yeah, damn. So I'm looking at this the ADMA, and I haven't looked at it in a while because I didn't really think about to look for it because I said I don't really look at these, but it's had a nice pump.
Biotech. So I actually have a buddy who I just lean on for bio plays. He's actually a director at a few hospitals in Texas, and he is just a freaking wizard. Like one of the smartest bio players I've ever seen because he understands the language.
Yeah,
Like he understands everything about it. He's like, dude, that product's never gonna work. Like he understands like the supply and demand of like the biopharmaceutical world. That's where he started.
yeah. So this is I forgot what they're doing something um, where like they're kind of controlling the market with something that they just created.
Really quick, how do we get King Sloth in here? He's like, it won't let me in.
King Sloth. I wonder if he needs.
He's in the
Yeah.
mailbox. Let me look at his profile.
Maybe he has to do the rolls.
Ooh, yeah. Thank you.
Okay, you got it.
Tried this, King.
I just King.
Anytime he says something, I could just like hear it in my head. I'm like, I know exactly how he sounds.
I just King.
Oh, I need to get some din din.
Yeah. Hey, bro, I made some really good chicken. I was at well, you're in the West Coast, so you guys don't have Publix, but down here in the South,
You don't.
we got a little
You
grocery.
Florida.
Yeah, we got a good grocery store called Publix, and you can like if you look up Publix memes on like just Google search, like you actually find like a decent amount of them, which is really funny. But we've got Publix fried chicken, and it's probably like the best fried chicken. But I was like, damn, I probably shouldn't be eating fried chicken. So I went and bought just a bunch of like drumsticks and seasoned them up, and I had some like that Lowry's 15-minute marinade. I had like a jerk one, and then like a steak seasoning. So I've mixed them
Good
both
Lord.
together and marinated them.
Lowry's for everything.
Yeah, marinated them for
I
2 days.
slap it on everything.
Oh my god! And then I had some extra like some like chicken seasoning, and then put some other shit on it, and bake that shit on low for at like 320 for like 4 or 5 hours, and then just let it sit in there. And oh man,
You're
it
a
was.
patient cook, man. I can't do that.
Yeah, I literally like I put it in, and then I was like, all right, time to Discord and forget about the chicken. And then like right before I went to sleep, I cut it off, and then just let it sit for like another 30 minutes out, and then snacked on it,
Bada bing,
wrapped it
bada
up.
boom.
Oh man, and it was juicy and delicious.
Nice. All right, we're gonna kick this baby off. So if you want to start your recording, that would
Oh
be
yeah, I
perfect.
forgot to tell you I had already started recording.
Beautiful. We're gonna have a small turnout today. It's totally fine. So welcome everyone. In case y'all don't know, my name's Klutch. I've been a technical analysis trader since 2014. I've traded all markets. I love all markets. They're all equal to me. But my favorites are going to be like equities, options, and crypto. I kind of play with commodities, futures, and the occasional OTC markets. That's going to be specific to the US. My trading style, personally, and keep in mind there is a difference between investing and trading, but my trading style is I trade specifically off supply and demand and Elliott wave. The goal of all of these meetings is to make sure that I'm providing you guys with some quality educational content of things that I've learned in my time of trading and things that I've either piggybacked off of other people or just kind of added a little bit of sauce to it myself. I'm not reinventing the wheel with this. I mean, none of this is my own. This is just things that I've picked apart that's been available to me through just reading and watching YouTube videos. But also, I've been mentored by some really phenomenal traders and investors that have really, really kicked up my trading. So my advice to you guys, if you're looking to educate yourselves, I mean, we only do these like once a week, but definitely take to heart what I'm going over and find ways to add this on to your own trading as well. Um, Disclaimer: I'm not a financial advisor. I am not licensed to give you guys financial advice. So anything that y'all hear and that we say here or it's in writing, this is all for educational purposes and for entertainment. So just to go a little bit of the rules in case y'all haven't been here before, I have rules when it comes to trading, and you have to as well. My number one rule: capital preservation is everything. You don't preserve your capital, you're adding into your account, and that is not a positive trading strategy. That's how we're losing money and how this is not going to be profitable for you. Number two, always have a plan. You have to have a plan with your trading, and this is going to be what our agenda is going to be going over today. You need to know when you're right in a trade. You need to know when you're wrong. You can't have emotions in this. You need to, number three, treat trading like a business. So we need to separate emotional and logical intellect, go based off of factual data, not off of, oh, this what ifs type situation. Hope isn't a strategy. um, Number four, use chart history to identify your edge. So my trading style may not be the same as yours. I go off of Elliott wave and supply and demand. Some people, I mean, if we're talking about crypto specifically, some people just go off of bullish and bearish divergences to get out of a trade. Like if price action is coming in from the underside on a listing, you're going to see that that's a bullish divergence. We can kind of go into that, but other people will have different means of trading. Number five, only risk what you can afford to lose. This isn't a casino. You guys need to make sure that you're either taking money that you are going to be setting aside for hobbies or for fun stuff that if you lose all of it, you're not going to be bankrupt. You're not going to be panhandling for rent, those types of things. Number six, trade on facts, not emotion. This is so important. I go over this over and over. You want to be trading on not emotional intellect, but logical intellect. We need to be going based off of facts. It can't be trading like, oh my God, I just love this PFP. It looks so pretty. Or, oh, I love the name of the stock. Or someone told me something. We're not going off of hearsay. We're going off of facts. Number seven, be disciplined. If you're not disciplined, you're going to lose money. You're going to be in a bad spot and you're going to hate trading altogether. So you have to be disciplined. And that's going to be one of our biggest talking points today. Number eight, learn proper sizing. We're going to go over this today, so I won't highlight anything. Number nine, knowing you should take a step back. If you're just accumulating losses after losses after losses, like over the last 10 trades, you're 1 out of 10, it's a good time to take a step back, analyze what you're doing wrong, figure out, did I enter in at the right time? Was I jumping in just based off of, oh my gosh, this thing is running, I have to be in it? You always need to know when to take a step back so you're not just compounding your losses. You want to be compounding your wins and not your losses. Number 10, market's always right. Doesn't care what you think, doesn't care what anyone says. The market's always right. You buy a trade, goes against you, the market's right. It's a brutal lesson, but you'll learn it. The market is always right. And today's agenda, we went over the welcome, the intro, we reviewed our disclaimer, we went over our trading rules, and today's lesson is going to be trade management and risk profile. So we're just going to dive right in. Risk profile. So we're going to go off of an example of like a $10,000 trading account. Obviously, everyone's account size is different, but you can use these percentages to kind of help you. The goal of this is to make sure you're not being overexposed in a single trade. You're not going all in on your portfolio on one trade because that's not being disciplined. You want to make sure you're spreading your capital out and you're managing your risk based on your intent of your trade. Shorter time frame trades have a higher risk because typically they're going to have higher volatility. So there's a few examples here. There's scalp trades, which is, you're just taking this trade for the day. It's something you want to be in and out of quick. It's not something that you're buying with the intent to hold overnight. If you are, you didn't plan your trade correctly. So if we're taking like a momentum play, that's going to be a scalp. If we're taking a mint play, your intention might be to mint it or, get something on the secondary for a quick flip. So for scalps, I typically don't like to size in more than 5 to 10% of my account. So if we're going off of like a $10,000 trading account, 5 to 10% is going to be anywhere from 500 to $1,000. And the reason why I give ranges is because different plays give you a different sense of confidence. If you see, like, we're just going to go off of NFTs, for example. If you see something that has, you're in their Discord, you're watching their Twitter, you can tell it has organic engagement. You can tell it's not just completely driven by bots. You can have a higher sense of confidence in the play because you can tell there's a real organic community that's backing it. And there's going to be more interest and more demand for their product, which is going to give you a higher sense of confidence. So you'll be going, on the more north side of it by positioning 10% versus 5%. But if you're not sure of it, but you can tell it has a lot of hype, something along those lines, you can still be going around like a 5%. Um, Swing trades. So this is if you plan on swinging it into a different day. These can last days, weeks, months. You will define what your swing trade is. If I'm swinging something, it's typically a week or two for me. There's been instances where I've been planning it for a month and I can take a bit bigger positioning on it. But typically, those I'm going in maybe 15 to 20% of my total account. And so if we're going off of 10K, it's going to be anywhere from 1500 to 2000. Again, it's all based on your own confidence. So there is a tiny bit of emotion in this, but it can't be your deductive reasoning for why you're getting in something and why you're getting out of something. And so for the confidence play, again, you're gauging the sentiment, you're seeing real organic people interacting with it. There's a demand for the product, and you can read the writing on the wall and see that this is a highly sought after, asset that people are looking to obtain. Lottos, I guess, in NFTs, it's called degen plays, but where I come from, it's called lottos. I'm not risking more to 1 to 2% of my portfolio on this. Like if it's a total degen play where I'm like, this thing looks, it seems risky. I can smell the stink on it, but there is a lot of hype on it. Like I'm going to be going in a smaller position, 100 to 200 bucks max, and that's again based off of a $10,000 trading account. Investments, this you can ignore everything that I set up here in regards to investments because this is for trading. Investments is a completely different set. Um, just to go over, I guess, a rule that I do have because it's part of my risk profile. If I have an investment account, oh, and keep in mind, I do have separate accounts. I have a scalping account, I have a swing account, and I have a lotto account. They're all treated differently because my mindset is different each time I go into those accounts. So, I mean, let's say I do have a $10,000 account, I do split these up between these. And my goal is to, take my degen plays and roll them into my scalping account. We'll go over this, but let's say, for example, I have 10,000 and at the end of the week, I have a positive return. At the end of that week, I'll rotate that positive return into my investment account. I want all of these separate accounts to be working for me to feed my investment account. So I do have separate accounts where they do have their own rules, their own set of returns that at the end of the week, they get reset. I don't add to it. If I have, a $10,000 scalp account and at the end of the week I'm down or I only have 9,000 left, I'm not adding to it. I have to be stricter in my trading. I have to be more confident in the plays I'm taking, and I have to manage my risk accordingly. That's the goal with these. You don't want to be adding money into these. You want these to be earning and accumulating money for you with the intent of rolling them into a longer term investment account. So for my investment account, I only have 80% of that entire portfolio sized in, meaning I keep 20% set aside in cash for in that investment account at all times. The reasoning for that is you have to be ready if the market has downturns. You need to protect your investments. And this is a lesson that we will go into on a different day. Um, but when it comes to sizing in, if we're in 5 to 10%, 15 to 20%, 1 to 2%, when you're fully sized in, you need to know where your stop losses are. Everyone's is going to be different, but me personally, I have a max pain threshold of 30%. And the reason why is because I have a 2-to-1 risk reward ratio, meaning if I'm willing to risk 30% to make 60% on my return, you only have to be right 50% of the time to be profitable. So you don't have to be right 60, 70, 80, 100% of the time. It's not possible. You're going to have losers, but you have to manage them. So when you're managing and you're entering a trade, this is what I mean by having a plan. You have a 2-to-1 risk reward. You know what your position size is. We're not getting overexposed. We're not getting greedy. We're not trying to shoot for the moon. We're not trying to YOLO our entire account to make a killing on a play because it doesn't happen. You're going to have losses. And so you need to manage your risk and you need to manage your size appropriately. So that's why I say I stop out at 30% because in my mind, I think a 60% return is absolutely possible because those are the trades that I look for. If I don't see a 2-to-1 risk reward and clear writing on this trade, I'm not taking it. You don't have to be in a trade every day. You have to wait for those moments where those moments and those stars align. Does anyone have any questions, comments, anything you kind of want me to reiterate on this particular tab before we move on to the next one? Unmute yourself and ask.
Hey, Clutch. I just got a question. Do you have a specific point, like, I say you have a stop loss at 30%. Do you have a profit, like a specific point where you just think, all right, this is good enough, or does it just vary from trade to trade?
It does vary from trade to trade. So I mean, I did create this. So I mean, I have some like real life examples of like alerts I've had in like my other room when I was, a heavy options moderator. So I mean, for example, by the way, this is all options on the left side. On the right hand side, it's crypto. If you don't know what options are, they're contracts. So if you see 0.75, that's 75 USD. If you see 0.91, that's $91 USD. But when I entered this specific trade, it was a risky trade because you can see the date is 8/25 on here. My expiration, meaning by the time that this trade expired, it expired in 2 days. So it was a high risk trade. But I knew that I was taking this trade for the plan of holding it overnight just based on what I was seeing. So before the trade closed, like meaning, in US, stock market is open from 6:30 in the morning until 1 p.m. So before the day closed, I made sure to take out a small return for 20% gains because I needed to capture something. So I wasn't fully sized into what I know was a risky trade to hold overnight. And when we opened the next day, I just slammed out all my gains. I was out for 126%. I didn't look back, didn't care if the trade kept going the right way. I was out. It was probably a mistake, but I just wasn't sized in fully. I only had like a 3/4 position on there, and we'll go into that on scaling into a trade. But it's all based on confidence. And so I typically we'll actually divert back into scaling in and scaling out, and then I could actually probably come full circle to your question. Is that all right?
Yeah, that's perfect, man. 'Cause I just find like my biggest problem I've found when I've invested is just never knowing when to take profits, and sometimes I just get caught up in the hype, and I've sort of been learning to just be happy with what I've been given in terms of a profit, and then
Profits
understand
are
that
gifts. Freedom
I've
like
been
gifts.
understanding that people sell orders, etc., like that, when people have their the Fibonacci
Mhm.
I can see that it applies in NFTs as well. You can,
It
if you
does.
sort of,
It definitely does.
yeah. So I've definitely been learning that, and I feel like that's been beneficial on my part. But yeah, thanks for answering my
Beautiful.
question.
Oh yeah, I mean, we'll definitely dive deeper into it as the lesson goes on. Um, so we went over risk profile, what kind of positioning we should be taking in certain trades. I mean, this is my own personal one. You can tweak it to whatever makes sense to you, and whatever's comfortable for your own risk profile. But this is my personal risk profile. So whatever this is may not be the same for you, but this is what I'm comfortable with. This is just what I've seen a proven track record be successful with in my trading. So tweak this, write it down. You can take screenshots of this. This will be recorded so you can revisit it. But this is my personal risk profile. Yours may be different. If you ever need help with trying to identify it, my DMs are open. Shoot me like a question, anything like that. I'm happy to kind of help you dive into it. And so I scale into trades and I scale out of trades. I have a few different like ways to it, but this is how I can dollar cost average into a trade, mitigate my risk, because I'm sure you guys have noticed if, like, for example, if you see a setup and you're like, oh my gosh, I've got $1,000 on my account, I'm just going to slam $1,000 in it. Oh crap, the trade's going down. Oh my god. Okay, I need to exit. And then you just lost 20% of your entire portfolio on one trade because you didn't scale into it. So this is a bit of an example of how I scale in. I personally like to scale into trades in thirds. It's just how my mind operates. It's how I prefer to do it. So let's say, we're taking a scalp. The first time I'm taking a position on it is going to be a 50% starter size. Meaning if, wait, hold on, I think I have it written here. Yeah. So let's just say, for example, my total risk is going to be $1,000. My starter size, if it's 50%, then I'm leaving 25% incremental ads into that play so that I can dollar cost average into it. So if we're talking just USD terms, if my total, allotment for this trade is going to be $1,000, my starter is going to be $500. And we'll definitely kind of go into like what dictates a scale in, but just for informational purposes, I'm going to be scaling into increments of 500, then 250, then 250 again. And that's just so you can dollar cost average into it. If your entry's at $1 and price kind of dips down 20%, well, now you can add in 25% position size at 80 cents versus a dollar. So you're dollar cost averaging into the trade. And then if you start seeing at that 80-cent mark that your trade is about to turn in your direction, you can still be dollar cost averaging into it and have a better positioning size than you would at $1. Because if you're at $1 and the price dips down to 80, I mean, you're down 20%. And that's not a great place to be. So you want a dollar cost average in your trades. You want to scale into them. So this is an example of thirds. You can do it in fourths. Thirds just worked for me really well, just because when I have 50% skin in the game, I'm a lot more. My senses just heighten a lot more. You get that rush of the trade. But if I'm in 25%, I notice I'm just a little lackadaisical, and for whatever reason, I'm just not as disciplined because I'm only in a quarter percent. So it's just a weird thing for me just to get my senses heightened, my blood flowing. Like I'm going in 50%. So we're gonna dive into this a bit further. So start with 500 and you leaving yourself two possibilities to add in additional $250 ads into it. This is to lower your dollar cost average. Um, but the reason I do this is I want to give myself the most possible edge I possibly can into a trade. And you're not going to get that just by slamming all in on the first go. And so you really want to DCA into plays. But I also have a mindset of where I refuse to add up. If my entry's at one and we shoot up to $1.20, that's it. I'm 50% sized in at a dollar. I'm not dollar cost averaging up. I'm dollar cost averaging down. The reason why is because it prevents you from having FOMO habits. If you hit it at a dollar and like, oh my gosh, it's $1.20. I need to scale in more. No, you're up 20% on this trade. Like you shouldn't be wrecking your average by adding in higher and only being up 10%. That doesn't make sense. So this is going to create discipline for you by dollar cost averaging down. There is a difference between dollar cost averaging and adding to a loser because Adding to a loser means you didn't have a plan. You're just adding out of hope that your trade is going to turn around for you. If you had a premeditated plan that you're going to dollar cost average into it, it's a totally different mentality because one, you're sticking to your rules. Two, you knew exactly what you were doing, that you had a premeditated plan going into this. And if you start to see it just fall apart in front of you, you're like, oh my gosh, like this was the wrong trade. You can exit for a minimal loss versus just adding and adding. So you definitely want to be able to read what's going on. You want to read the sentiment. You want to see if there's demand there. Um, Sometimes you get into a trade and it's just wrong. You could have read everything right, but for whatever happened, the market gods decided today's not the day and you're going to take an L. It happens. But you need to be able to differentiate how that's going to look. You could just be in NFT mines. You could just be seeing that you got in, during a post mint. It was minted at one sol. We're trading at 150 now. You're starting to see bots just sweeping the floor constantly. You're like, okay, I feel comfortable hopping into this. But then of nowhere, buying stalls and the listings just start popping up like crazy. That could be one of two things. It could be manipulation, or it could just be, hey, something happened and people lost interest in this immediately. So you're going to be able to need to pay attention to what's going on in the rooms, what's going on Twitter. Little things like that can help give you an edge of having social sentiment. And that's what's going to keep you disciplined, going to keep you knowing why you got into it. But those are things that are going to come with time. And so, how to know how to scale in more. I mean, that we just kind of went over that. But let's go over like a mint example. So let's say you're given 2 to 3 tokens and you're on a whitelist. Congrats. Not a lot of people can do that. How I personally handle mints is I like to see what the mint is doing. I want to have what's up on their, whether it's their own personal website, Magic Eden, anything like that. I want to see how quickly the mint starts rolling out. Because if you see immediate demand hammering that they have to have this mint, I'm immediately going to look at the secondary market and see what's causing that sentiment. Are these paid people that are really just trying to buy up the supply immediately, or is there actually a quick return immediately available on the secondary market? Because that's what's going to be that's two driving factors for an increased demand during a mint. Is if the secondary is giving you an immediate opportunity for a return, or if you're reading the room and seeing that there's just high demand for this mint, even though that there's a reveal later on, we'll definitely go into that. But let's kind of dive back into it. So if the project launches, we're not seeing high demand, I'm probably not going to mint it. I mean, this isn't to knock another project, but Snuggle Squad. I had a whitelist for it. I could have minted two. I could have minted even more on the public mint, but just seeing that there wasn't a whole lot of social sentiment for it. There wasn't a whole lot of driving factor and demand for that mint. I just decided I wasn't going to mint it. And even though that they gave you a mint price at 2 sol and dropped it to one and didn't cut their supply, I still didn't see that demand for their product. So I decided not to. But then you look at, this isn't a promotion, but if you look at Yeah Tigers, their mint was flying off the shelves rapidly. It could have been staged, it could have been an artificial pump, but the point is, when you looked on the secondary market, you saw that their listings were going 2x over their mint price. So it makes all the sense in the world to take that mint and get your quick return on it. And we'll go over how you can scale out of a trade. So it kind of goes back into Flex's question. But does this kind of make sense, everyone? I scale into thirds. I like to take a 50% starter size, and I like to leave some wiggle room to add in dollar cost average. I will highlight one thing. Um, how to really know when to scale in more, meaning your plan hasn't changed. If you got in because you saw that the floor was, here's an example. If the floor price looks stable, you like the project, you're kind of seeing a shift in maybe social sentiment. It could be on the Discord, it could be on Twitter. An influencer could have promoted or something, or their utility launched. And in your mind, the utility has a real world, use, and that you think this could have some demand. So you can take your starter position. You could buy one FT off the floor. Um, and everything I'm going to be going over is, it's going to be based off of just the floor price. We're not going to be going over rarity of any of that. It's just too complicated. So you'll be buying one off the floor price, and you see it kind of dip a little bit. Your reasoning for getting in hasn't changed, but maybe the social sentiment hasn't caught on yet. you could still grab another one. But if you start to see that this is starting to have no demand at all, well, then your reasoning is shifting. You were buying it with the intention of seeing an increase in demand, and it hasn't happened yet, but you're already positioned in, and it's getting dangerously close to where your stop should be. That's where you're going to need to have a moment of, did my reasoning for getting in this change, or did I just read the writing on the room on this completely wrong, and maybe I'm the only one that thinks this is great but nobody else cares for it. So NFTs are highly speculative. I mean, if we're talking just, trading on charts and things like that, it's completely different. um, let's just jump into an example real quick, just because I have to kind of tag on this, because this is just how my mind works. So let's say, for example, so this is from the 10, let's just go into a 15-minute time frame. Let's just say we're going for a scalp. So you can tell the gaps; those are clear openings. This is the 13th, and this is the 14th. So this is a full day of trading. Um, let's say that for some reason you have an itch to either short spy or long spy. We could be looking at this as a few different ways. That, how I draw my lines is a little bit different. I don't draw down to the wick sometimes if I'm looking for price acceleration levels. I want to see where we closed. So let's say that price is dragging down here, and we start, because these candles are showing range downward. When we start seeing these doji candles or these long wicks to the bottom, that's signaling demand. We're seeing that buyers are kind of demanding price at this particular range, and we could have a possible move to, capture some profit. So what you could do is, you know, I typically like to let three candles develop. Let's say, for example, this is our entry, because price is showing an increase in volume down here. We can see that, we had a high open, price is dropping, it's going lower. We're seeing a downtrend. But then all of a sudden, we see this upward trend pop up, because this volume candle is lower, lower, and lower. And this green one in specific here is a flip, meaning that you see a increase in price. You're seeing an increase in volume. And in return, you're seeing a increase in price action. So you could have entered the trade on a break of the high of this candle, because you don't want to do it on the low. You want to do it on the second candle or the third. Typically, I like to do the second candle because that's giving me a bit more confirmation. And my stop could be the low of the lowest candle of the day. So I know my risk reward. I'm getting in because I'm seeing, volume increasing. I'm seeing we're having a nice rounding bottom pattern. I'm seeing wicks at the bottom of these candles, and we're breaking the high of the second to last previous high candle. So I could have got in, and I could have maybe been edging to see, this is a 8 EMA, so it's an 8 exponential moving average. I could have been taking my start here with a profit target of, I like to keep it around 20-30% for my first scale out. We'll go into it, but I know why I'm getting into this. I'm taking the break, my stops here. My profit target range could be tagging this 8 EMA, because if you look at the history, price action gets a little sloppy when it gets to the 8 EMA. So I want to be scaled out by the time I hit that. So I'll scale out into it. But let's say I buy this and this candle stalls. Well, reasoning why for I got it is because I started seeing a strong social sentiment pushing price action up. I mean, we could have be using this as an example. We'll just shift it over to here, because this was a great example of when you got in and why you could have scaled in. You could just gotten your 50% entry here, your 50% size in. We're not averaging up. But let's say, for example, we had that same mentality here. Price is dropping, we're seeing a nice stall, and then we're seeing price action having an increase in volume, and we're taking that trade. We're breaking the high of this candle here. This is the second to last candle before the bottom turned. I could have got in, and then we see price action stall. Well, the reason I got into this was to take advantage of price action's momentum. And if I see this starting to move up and then we slam down and we're kind of chopping, 9 times out of 10, I'm exiting this trade, because the reason why I got in doesn't exist anymore. So that's a good reason of knowing when to just get out of a trade, and knowing when you're right on a trade and when to take profits and continue to let the ride go up until it tells you otherwise. Um, I know that was a bit of information to take in, but does anyone have any questions on that, or anything you want me to elaborate? 'Cause we'll be going into scaling out in just a second, if that's what your question was. Going once, going twice, and we're moving on. So you can scale out of a trade a few different ways. So we went into scaling in. I like to scale into thirds. Scaling out can be a number of ways. Typically, depending on my confidence, I'll be scaling out into thirds. If I'm a little unsure and I know this is just a momentum play, I'm going to be scaling out into fourths. And there's a few reasons why. So, how to scale out of a play. This is obviously going to depend on your trade plan. Personally, I like to get the hell out 2/4 of my position size into my desired profit target. And I don't have a crazy profit target for my first scale out. It can be anywhere from 20 to 50%. There's a wide range in there for a reason. Because in whether it's options trading, NFTs, crypto, that move can come quick. So if you're seeing a lot of movement in price, you could take advantage and really just be patient and wait for that 50% return. Because if you can get out for a 50% return of 2/4 your position size, you're sitting really pretty. I'm not shooting for the moon. I'm not buying, let's just say this is NFTs. I'm scaling 2 NFTs out of 4 of my total position. I like to scale out of plays because I like to mitigate my risk. I like to return my capital back to my wallet, and I like it to be more than what it originally came in with. So let's just dive into an example of what scaling out into thirds looks like. So if I'm scaling out into thirds, we can't scale out 25, 25, 25. You could scale out 33, 33, 33, but typically I like to exit 50% of my position on my first exit. And then I can leave an additional wiggle room for another 25% exit. And depending on how you played it and where you exited, you could potentially have a remaining 1/4 position size in your trade for free, meaning you scaled out of your trade perfectly. Like, let's say you got in for a total of 4 SOL on an NFT that cost 1 SOL. And when you exited your initial 50% exit, we got in for 1 SOL. Let's say we exited this position at 150. We got out at 1.5 SOL. And then at this one, we got out at 2 SOL. Well, if you do the math, we have 3 SOL. Sorry, we have, oh, I did my math wrong. This is 3, and then this would be 4, 5. Yeah. So if we entered the trade with 4 and we exited correctly and got 5 SOL back, you have an immediate profit. You have 1 SOL in your wallet. So you can let this 25% trailer, that's what I like to call them. I like to leave a 1/4 trailer. If the getting's good, I got my profit and now I have a at least a profit on the trade. And I have a trailer that I can just let run. I mean, I like to call them moonbags because in crypto, you really never know when something can just rip, and you're going to be glad as hell that you had a trailer in there for free. So there's ways that you can scale out and scale into plays where you can let yourself have a free position. That makes sense? I'm going to assume yes. You can scale out into force. I mean, it's the same thing. You're exiting 25%, 25%, 25%. And then if you did it right, this last 25% exit, it could be optional. But I mean, you really need to dictate if that position is going to work out or if you're just going to let 25% go to waste. So I like to have rules where I don't let a trailer run against me past a certain point because it just doesn't make sense. Why would you let a loser become a bigger loser? We'll go into some of that in some of these real examples. But your goal when you're scaling out is to make sure that you're maximizing your return efficiently without emotion. This is kind of a question we had earlier on where it's like, I don't know when to exit because the hype's, the hype could be really good on a play. If you're holding one NFT, my gosh, it's going to be so tough to dictate that. But if you're holding two, three, four, that decision making is going to be already laid out for you. Um, we'll go into some real life examples of, how I scaled out. If I can remember my mentality on the trade, I typically do remember the majority of my trades. But the biggest thing is when you're entering a trade, you need to do it without emotion and you need to stick to your plan. If it helps, write your plan on a freaking pen and pad. There's a big, powerful piece of writing things out because, in a weird way, we're creatures where we stick to them. So, write your trade plan out if you need to. But let's just say you don't want to be greedy. You definitely don't want to be greedy when you're getting into the trade. You want to have a plan and you want to stick to it. Because if you get greedy, you're going to get sloppy, you're going to be undisciplined, and more than likely, losses will start piling on because you're not sticking to a plan you're getting greedy, and you're just shooting from the hip. Don't do that. We make sure we're being concise and consistent with our profit taking because it builds good habits. Like even if I know a trade's cranking, I'm still going to be exiting because I built it into the fiber of my being. I just exit trades on reflex. I don't even have to think about it anymore, because I like to have good discipline when I trade. In a perfect world scenario, if you could be out 2/4 of your position at 100% return, you are in the best spot possible. Let's do an example. You bought 4 listings on the secondary for 2 SOL. You sell 2 of your holdings at 4 SOL for a risk free trade. You're selling 2 of them to collect your return, and now you have 4 SOL in return. Even though that your initial entry, you were taking them for, hold on, I gotta do my math. If you bought 4 listings on the secondary and they're 2 SOL each, but you sold 2 of them at 4 SOL each, 2 times 4, you're break even. I mean, obviously the royalties and all that kind of take a little divvy into it, but you need to take it with a grain of salt. Your goal is to be holding a risk-free position because you're mitigating your risk and you never know what the hell can happen in this market when you go to sleep. You don't want to be holding, hoping, wishing that, you could have exited a perfect mint before the reveal happened because you were just too greedy thinking that this thing could absolutely moon. It's not disciplined. You need to exit, you need to take profits, and you need to protect your capital. It's rule number one. So we can go into some, examples of this. So these are just examples of, even though I knew it was mooning, I still took the necessary precautions to get the hell out of the trade. So I got in, I only had 1 entry. I didn't get to scale in. I just took my 50% starter size. I exited 20% before the market closed, or in our case, before you went to bed. And then when I woke up, I noticed I was up big. I took my profits and I didn't look back. Um, this isn't like an example of what we went over for the method, but it was a high risk trade, so I needed to take my returns and get the hell out. But on this one, again, high risk. This is dated 9/16/2021. The call option expired on 9/17, so it expired the next day. So when I got in my trade, I just got in 50% because I wasn't feeling too risky about it. But I scaled out half of my position immediately at 30% return. Well, the goods kept giving. I got another chance, so I exited 3/4 my position at 50% return. You can see that these aren't crazy numbers. Like I'm not exiting at 60, 70, 80. Like you'll look down, you'll see it. It's pretty consistent. Um, I exited the entire trade more than likely the next morning for 128% return. It could have kept going. It doesn't matter. My goal is to keep compounding my capital and having it work for me, not being greedy and not letting trades run against me. But here's an example of where I scaled in. I got in a trade. This is dated 9/14. You guys can tell I like risky options. I got in at the trade at 0.66. It was so quick. Who that is? I got in so quick that I had to update it from a live chat, and I scaled in equal size, meaning I just took 2 scales on this. I went in 50% and then I added another 50% almost immediately after. Um, my entry was 66, I averaged in at 51, my average is now 58. I took my 2/4 scale when the getting was good because my average was down. You can see that my exit was at 69, but my initial entry was at 66. So had I not averaged down, I wouldn't have been able to get out for that return for a quick 20% return. So that's why we always dollar cost average down and not dollar cost average up. Um, movement kicked up really freaking quick. I mean, I was right on the trade, but I let it go probably a little too long because you can see I got out at 125% return and then I exited out the entire position at 164%. So obviously, this is an example of the move happened quick because otherwise my scales would have been a little bit more moderate like these. But even though that I could see that the movement was getting there, I still locked in my return quickly. I didn't just hold my entire position. I could have exited the holding at 164% return, but it would have been a gamble. I want to lock in my return. If the getting's really good and you can, accurately read what price action's giving you, you can hold on to it for a little bit, but it does come with experience. So I exited, 3/4 my position at 125%. I was writing it well risk free. But after a while. I mean, sometimes I can get bored, or I'm just like, you know what, I'm happy with this, I'm out. Um, we won't go into this one. I mean, sure we can. It was a risky position. I got in. You can tell there wasn't uh, a secondary scale in. I got in the trade, and then I started scaling out. Scaled out one force, then I scaled out another one force, and then I'm gonna get out because price action's turning. But these are examples where I was scaling out into positive returns, but I kept my stops in check. So even though the getting's good, you could be scaling out into a play, but when it turns against you, you need to know when you're cutting it. So AMD, for example, this was like a 3 day. It was a scalp. I entered in. I didn't scale in. I got in my 50% return. It went well right off the bat. So I exited 2/4 my position. I got out half size at 20%. Got out another 3/4 at 30%. But this is where I know I'm holding more than just a even numbers amount. I'll get out 90% of my position and just hold the trailer if I think it's about to turn against me. So I'm like, okay, like I could have had 5 shares of this. I exited, 2 shares. I exited a total of 3. I exited a total of 4. It was 50%. I was holding one, but I exited at 180. When I saw it going against me, I mean, I gave myself a lot of wiggle room. It probably fell apart really quick. But if I'm holding one, I mean, this is the beautiful thing about options. I can set a stop loss and set it at my break even. With NFTs, you can't really do that. So it's a bit tougher to gauge, but you want to have an idea in mind of when you're going to get the hell out. Another risky play. I took my starter. I took my ad. I'm adding down. I got a 0.745 average. Wasn't going well. I cut my losses and I got out. Um, Same thing for Tesla. I got in, didn't scale in. I'm just in 50% size. I scaled half at 25%. I'm taking that exit for that 3/4 position. I may have just forgotten to post it at 42%. But then when it started turning against me, you can see that this was at 320 when I took my exit. I closed my trailers at 270. So if you're in a play, have a stop loss in mind for either your full position or even your starter. If price is going against you, 20, 30% is a good place to stop out. But when you're up and you're up, let's say 42%, give yourself a 50% trailer. Meaning if I'm at 42% return, it goes against me. Let's at least lock in that last one at 20%. Don't let it go against you. Don't let a winner turn into a loser. So if the getting's good, you've got your gains, hold on to it. There's no need to be greedy. There's no room for emotion in this. The market's always right. You're going to be able to be right some of the time, but the market's always right. So set these rules in place so that you can make sure that you're taking advantage of being on the right side of the market versus holding and hoping and just not having a disciplined, trading style. But you can see like I exit almost 20% as often as I possibly can. Just one more example. Um, I got into my play. I scaled one out. Okay, the entry was 255. I got out one position at 290. I got out 2/4 of my position at 340 for 30%. Started going against me. I got out at 275. You can see I have a habit of just not letting these go against me. Because if I did, I'd be having very poor discipline trading and it wouldn't go well for me. Does that kind of make sense to everyone? Like you want to have a plan when you get into a trade. You want to protect and preserve your capital. You want to have set stop losses in mind. You want to stick to scaling out targets. Um, I mean, NFTs, you could probably juice these numbers up a little bit. It's because mine was such high risk. Like these were, I got in at 810. The contract expires 813, whether I like it or not. So you can treat them a little differently of how you want to scale out, but it's all based on your own risk. That kind of makes sense. Going to assume it
Yes.
does. Thanks, Lex.
I thought you'd get a bit tired talking to yourself, so I thought I'd respond one time.
No, I'm fine.
I
But
think
I mean,
we all just sit here kind of amazed. We're like, wow, this guy actually knows what he's doing. Usually we just
Yeah, I
kind of
picked
hit.
my jaw up off the floor.
Usually it's just us. We hit buy and we're like, did it 100x? Nope. All right, gonna sell it.
no. So this is something like when I did have my trading room, I would purposefully make my students have their own plan. If I'm getting in at 255, I'd be like, where are your exits? And I'm like, I would ask them, where are you cutting? Where are you taking profit? And I wouldn't give an update on the trade until they answered me. Because if they didn't answer me, I'm like, okay,
Yeah,
I'm gonna
that's
give
kind
you
of like
delayed. I'm gonna give you delayed reactions. You shouldn't be waiting for me. I
had a
taught you enough to know this, but I would do it live too.
there on the spot.
Yeah, I mean that's one thing. Like you said, like, I want to just go on that you said. Know where your exit's at.
Because I bought a cat, at one something, and I still hold it. And I like the community, and I like the NFT, and I definitely think there's a bright future for them. But I mean, now they are a little down, but
they did hit that 100 soul, and I told myself, I was like, man, if these ever go to 100, I'm gonna sell it. And then you kind of get that greed. You're like, oh, it could go higher, and then it gets to that point where it's like it went down to 80, and you're like, oh, it's just a pullback. It's gonna go up, and then like I saw it go down to 50, and I'm like, well, I'm not gonna sell it unless it goes over 50, and then now they sit at like 37, 38, 40 area. Um,
so it's like, do because you're up in profit so much already, but do you hold it and see where it goes in the future?
Hodo.
Do you, yeah, hodl. Do you see where it goes in the future,
Or you cut your loss and be like, all right, well, I got to gain. So, I mean, for me, I still will hold my cat for a while and see what happens in the future. But yeah, if I would have, if I would have sold
my
it,
biggest lesson is your gut's more than likely right, and your mind's gonna trick you. If your
yeah,
gut says I should sell it at 100, it gets to 100. Fucking set your sell order and don't think about it.
yeah,
If it
no,
keeps
that's
going, so what? You
yeah,
made out
exactly,
some Gucci gains. Celebrate. Don't look back on the trade after it's done. I mean,
yeah.
it
Well,
like
that's when you start to flood the project
can.
after you sell.
Well, you can, but you have to mentally know that, hey, no matter what the hell I see on this, I traded my plan. My plan worked out well. I captured a return, and I'm not going to FOMO back in. There's times where once I do it, I'll delete my trading app if I know I'm going to go back and look at it. Like I'm literally gonna cut myself off. I could even call my broker and I'm like, don't let me trade anything else today. They're like, you got it. No more trades today. I'm like, thank you.
I think
I've had to do that.
don't get
Well,
emotional about your NFT as well.
yeah, you can't. You have to have a rhyme and a reason for why you're getting in it, and you got to stick to it. Like for example, I don't even know if we can actually see this. Maybe I could pull. I mean, either way, like when I was trading crypto and we were in the bull run, I would be giving plans in advance where I'm like, this is my entry, this is my stop loss, and we would be scaling out. Like we would give. This is gonna make me so mad if I can't. Oh, it looks awful. Never mind. Nice idea though. But I'll give examples of here's where I'm entering, here's my stop loss because I like people to kind of know and think and see what my trade plan is on the spot. And luckily it worked out. But I had my profit targets. Like we're going to be 30%. We're going to capture our return at 1/4 here. We can capture our remaining position here, and we'll leave a moon bag. It didn't work out at 30 and 50. It worked out at 20 and 36 because you have to be reactionary. But I got out of that trade, and then when it started going against me, I cut it. I probably just forgot to update it, but I did it in chat. But does that stuff like kind of make sense? Like I have a rhyme and a reason for why I'm getting in it. I take quick profits because I like my account to compound. I don't want it to be a depreciating account. I want it to be an appreciating account. I take my profits quick. NFTs, it's a little bit different, but I mean, this is how I traded options, and it worked out really, really, really well for me. So I plan on doing that same thing with NFTs. But like full transparency, I'm still relatively new to the space, so you won't see me learning or calling anything out until I feel 100% confident and I have a solid read on the market. So I'll be partnering with people like Flex, Maniac, Unique, some of our alpha callers in here that have been doing a great job. I plan on learning from them while still implementing my own rules to it, and hopefully I could piggy like if we get into a situation where let's say Flex calls out a trade, I take it with him. I'll be he'll have his own set of rules for what he's doing, But I mean, you guys know where I'll be scaling out and how I'll be scaling out. So if you guys have any questions on it, like if I took something and you just want a little bit of discipline of how you should exit, I mean, just feel free to holler. But just know I'll be following my disciplined rules because that's what's got me here today. And I don't plan on deviating from it ever. That kind of makes sense. Do you guys have any questions or kind of like anything you want me to elaborate on this? It's a lot, but we
Yeah,
will
it's
be going more into it.
I'm loving what I'm learning here. Some
uh,
So
it's and some of the stuff
what is this?
is
that you know in your heart, but like you said, it's that mental mindset of
you got to put those barriers and those spots in of entering and exiting because we all
You
know
got to.
we all know what we're supposed to do at the end of the day. I don't think anybody goes, "Oh man, I can't believe I did that." It's like
I can't believe I listened to myself or I didn't listen to myself. But I think
How
we
many
all
times have you said that? I mean,
exactly.
this is a rhetorical question, but I want you guys to realize that in some trading scenarios, you are your own worst enemy. How many times have you gotten into a trade or a project or something like that? And you gave yourself a price target. You're like, you know what, if this thing gets to here, like I'm getting the hell out. But you don't. You get greedy. We hit that price target and you're like, man, if we can go another X, Y, and Z from here, like then I'll get out. You already broke your rule. You broke it immediately, and you should get the hell out of that trade. Because if you don't, you're making bad reflexes for yourself. You're creating bad habits. You want to be making good habits consistently. Because, like that model said um, on a previous slide, is that if you're right 50% of the time, but you have a 2-to-1 risk reward ratio in mind, meaning if you get into we're going to be using NFTs. If you get into a project, it's at 1 SOL. Your stop loss should be at zero point 0.5 SOL, like max. But your max return should at least get you to 2, so that you have a 2-to-1 risk reward. Because if you're only right 50% of the time, you are still profitable. You have to place those rules in for yourself, and you have to be disciplined about it. No hopium in this market; it'll take advantage of you. Do you got anything else, or like you can use the event chat, and if you just don't feel like talking, it's open. um, so if you just want to type, you don't want to share your voice, it's all good.
Clutch, are you still sorry if it sounds a bit echoey, I'm in the bathroom. But are you still shorting the market at the minute, or are you just taking a step back, waiting for it to sort of figure itself out, or what's the deal with what you're doing right now?
So I'm not short anymore. I mean, like, I got my move. Like, so for example, when I see this type of price action, it goes back to our earlier lesson about supply and demand. Price was in agreement here, so I do nothing. I need to wait for a range breakout, or I need to wait for us to test some supply or some demand. But sometimes I'll deviate from that plan just slightly, just because I know what I'm doing. So my trade plan was, when we started to have this doji candle, I was like, oh, we have some indecision. We tagged the 8 EMA and we wicked down. And the next 4-hour candle that opened, we broke the low. I was waiting for us to break this price level, because if we did, that means we're breaking out of this range, and this is now creating a level of supply. So I knew that this was about to be a dump. And so I took a position for, I mean, this is June 9th. I took a position for like 2 weeks out, and I exited the same way I did where we went over in this. I could have exited fourth my position at 30, scaled out another 3/4. It didn't go like that. It went a lot faster. But I let that trailer just ride until when we got to here, I was out 3/4 my position. And then when we hit this day, I was just out all. It was a very handsome return, just because options accelerate. I mean, just on SPY alone, this was my entry. I got out on a I got out on a 29-point move on SPY. If you know anything about options, that dollar contract could have easily turned into a 30, 60, 70, $80 contract. Like options move quick when you're in the right way. I need to capture my return so I don't get greedy and I don't build bad habits. But right now, this is nothing sexy to me. We're chopping, we had a little pump, we failed demand here, so it gets deleted. We tagged my larger demand area that I've been waiting for us to test, but I'm not seeing any reaction. This is a daily candle. We tagged it, we're dojing. It's a doji candle, it's indecision. When we tag demand, I want to see big old green dildo candles. Why? Because that is showing a increase of demand that's exceeding supply. So we could be dipping down a little bit more. I mean, techs are saying we're oversold, we're tagging demand, but there's no price action here that's making me jump out of my seat to, take a trade. We have my lower levels down here. This is the 100% retracement, 88.6, 78.6. We're in demand, but we could tag this level. And until I see price action accelerate or we tag this fib and I see us respect it, I'm not doing anything. Like if we look at equities and just go to ES, which is SPY futures, I still think we could tag these lower levels down here. Like I only have this box here because it's highlighting a 88.6 retracement and a 78.6 retracement. So to slap that box on there. But this is a demand zone and we didn't really respect it. We went to the bottom of the range, showing there's not a whole lot of demand here. We went to the bottom before starting to slightly turn. So this isn't price action I like to trade. I really like to trade bullish impulsive waves because I know I can take positions at like key retracement levels and just let it ride. It's a beautiful thing. So when we're in corrective waves, it's sloppy, price action's crazy. You could have one day where prices, completely rocketing and accelerating, and then the next day we just go red for 3 days and we go back down to our lower level. You could be so red on this kind of move, even though it sprung and price just accelerated. This would have caused so much fear and doubt. I mean, 3 days of red with a false breakout, there's no trader in the world that would have just held that unless they were hoping and had a terrible strategy and got incredibly lucky. But that's just my 2 cents. So corrective markets, I don't like to trade. But in corrective markets, I do like to dollar cost average into investments. That's for damn sure. So I mean, as of right now, my investment portfolio is 80% invested, and I'm selling credit spreads and stuff like that. I'm just collecting small premium to just add fuel to the fire and just keep reserves set aside to add back into those investments when I think we entered some key levels of price pivoting. That answer your question? I know it was a lot.
Yeah, thank you.
I feel like you're brushing your teeth and just getting ready for the day.
Yeah, I'm in the shower, but hey,
That's awesome. But yeah, I mean, I'm gonna need to get going to dinner here in a little bit. But if you guys want, I'll give us just a quick little overlook of what BTC is doing and some Sol. So you guys probably see me in chat, talking, we're in a corrective wave, ABC down. My two big price levels. The first one we hit on a dime and pivoted. If you were here during our first lesson, we talked about this. This was my first level, and this is exactly where we moved down to, and price started to have a reaction. This isn't sexy enough for me to be like, oh my god, you guys, we hit bottom. The bear market's over. We're going into a bull run. This isn't enough. Like if we tag this level, I want to see price action just accelerate. Like I want to see a strong confirmation that we are in a bull trend. This to me looks like we're going to have a dead cat bounce and probably fade back down to this level before people really start to jump out of their seats. Um, some ways we can kind of go over that. So for example, if we're looking at measured moves, we're measuring in terms of Elliott wave. I know it's going to be a lot. You can tell that this is a measured move down because we had a nice price pivot. So I'd be drawing from the top of this. If you look over to the left, you see it lines up with it. I'll be drawing from the top of it down because I want to get a reverse retracement. I want to see how high we're getting. And you'll always see that 61.8% is always going to be marked in gold because 61.8% is the golden Fibonacci ratio. You can measure, from your wrist to your arm, it's going to be a 68 or sorry, a 61.8% ratio of your entire arm. Your from your elbow to your shoulder, you'll be seeing those ratios. They're all over nature. And for whatever reason, it works in trading and it works beautifully in nature as well. So right now, BTC hasn't cracked over 61.8% on this recent measured move. I'm not bullish yet. I want to see us break it. I want to see us break 100%, and I want to see us keep going. Um, those are ways that I can kind of figure out and dictate the strength of this move, but also see if we're about to pivot. So BTC right now, I'm not bullish yet. I'm not bearish. I'm neutral. Price looks like it's kind of in
So
agreement. We're
if
seeing a
it gets
slight.
to if it gets to that 61% and it starts to move over it, then that would be bullish for you. And
It needs to get above, break, and hold, meaning we need to see price action get above this level and close above it. It can come back down and test it, but that baby needs to hold because typically when it holds above, we're going to higher levels.
right.
You can see that example here where we broke, but we didn't hold. The next day, we broke, we dipped below, but we didn't close below, we closed above. And then we leveled up the next day. We dipped back down, but price action kicked it back up. We tested the next level. We opened up below it, price action moved above. We closed, but this is a 4 hour candle. I put a lot more weight into daily candles. And so when we opened on the next 4 hour candle, we went below. It's a lot of chopping action. But when we keep breaking and closing above those levels, you can see that natural staircase movement up. And you want to see that because it's healthy price action. It's showing that there's a demand to buy at this zone, and sellers are keen to try to overthrow it, but you want to see what bulls do in response. So if we're moving up this nice beautiful level up and then bears try to like lay a trap because they know we're about to enter 61.8%, people take profits before we get to the zone. That's exactly what it is. This is the profit taking zone. Bears took their profits. Bulls said, no, 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 we want a little bit more. Oh, just kidding. There aren't enough of us. There's so few of us. And then bears are like, all right, y'all ain't doing it. We're unloading the boat and taking it back down. Bulls are like, no, I need to, we're trying to gear it back up. So if we break this, I mean, I'll be intermediately bullish, but I'm not going to be like, hey, bear market's over. I need us to see a break here. I need to see a break above this supply loan. Like, this is kind of my line in the sand that, hey, we're back in a bullish market. Like we're breaking back above this whole retracement zone and we're up big. So showing that this demand zone was respected. There was a high demand here. I mean, you can see this volume spike. Like when we actually tagged this Fibonacci level and we broke below it, look at that volume. Like price was moving up while price action was moving down. But the second we tagged it and we opened on the next candle, we just rocketed. Like that is positive volume, but there's no follow through because volume's so dismal. If we tag a demand zone, I want to see volume doing this. I want to see these candles increasing, moving up, because when price is moving up and volume's moving down, that's super bearish for me. Like this isn't sexy price action. When when price moves up and volume's moving down, more than likely it's a trap or it's a setup for a price imbalance where supply can easily exceed demand because there isn't demand as price is moving up from cheaper values. So what happens when we get to a higher value and volume is just not there? It takes just a little push and sellers could easily overthrow it and just turn price action down. Volume is incredibly important. Study volume. I could tell you to look anything up on YouTube. It's how to study volume. Volume in conjunction with price action is a big, big tool that I use in conjunction with supply and demand and Elliott wave because volume's like my number one indicator. That's telling you where real willing buyers are meeting real willing sellers and what fashion they're doing it.
Now I have a question because I haven't looked too much into this. I know we're kind of over on time, but
Now with this Three Arrows
Okay.
Capital and Sam, I guess, bailing them out or whatever, what effect is that going to have on Solana as an ecosystem and just the market itself? Like, let's say if something does happen and they do get liquidated, is that going to like have a big impact? Because I mean, I hear it's like millions and millions of dollars that is on the line.
Surprisingly, millions and millions isn't a lot to me. Like in terms of market cap data, like if I'm looking at a whole global ecosystem of Solana, millions doesn't really bother me. I'm like, if it's hundreds of millions, tens of millions, a billion, that's gonna pique my interest, and I want to know a lot more detail. But like millions, I'm like,
Well,
it's
how
not that
much is
bad.
it? Is the Three Arrows Capital? Because from my understanding, I think it was like I know I feel like it was a significant amount.
Fuck, what's the name of this site? Happening here? Hotspot? No. There is it's not like a broker, but it's a really good analytics site that tells you what brokers are in there. So it's not really Solana's fault that a broker just completely didn't follow their own rules and just went deep into crypto and is now underwater because they didn't follow like simple investment strategies. They just followed in, held their position. Now they're down and they don't have money, and their investors are trying to pull out. I don't even know the market. I don't even know like what the actual headline of this is. But when a firm, a bank, an investor, needs to get bailed out, that means they don't have the money to pay their investors back for what their initial funds were, or they can't even pull out their position. Sometimes they'll freeze assets. Like if y'all watch The Big Short and Michael Burry was like, if people start to exit our position, we're gonna, negate our contract and they could liquidate us completely. And they're like, what the fuck, Michael? Like, why did you do that? He's like, well, I'm really confident on it. But investors were trying to pull out once they heard his big plan, and he's like, no, I'm freezing your assets and you can't pull out. Like there's things that people can do like that. Like Three Arrows Capital could have done that. They could have just been like, no, like we don't have the money to pay you to pull out your position, because if we start to pull out, we're leveraged and we're going to negate some kind of margin trigger where they're just going to liquidate us completely. And so they could have those orders be piling up and piling up, and they're like, we need to do something. We have to do what's best for our shareholders. So somebody please buy us out because we fucked up and we need to wash our hands of this. And we need our investors to be able to pull out of their money. So it won't affect Solana nearly as much as you think it would, because it's the bank or the investors firm's fault, not Solana's.
Okay. Also talking about Solana, looking at the weekly chart, we finally got a green candle.
This looks much more bullish than BTC, I will say. Because if we're looking at like this most recent drawdown on this measured move, we're going to be measuring from the top. I'm probably not going to get it 100%, but we're breaking 50%. We're about to tag 61. Not quite there yet. But I'm doing a bigger retracement move on purpose because I want to gauge the real strength of this, because this is where we tag supply. This is our supply zone. We draw down from our first lesson. We tagged it, and then we've just completely fallen apart from here. I want to see how we're going to be testing these like little mini supply zones. They're not significant. They're not significant, but they're not insignificant. Like literally right here where we tagged this zone where price started to accelerate, we tagged it on a dime, and just price fell. So when I start seeing those little pivots play a role, I get a little cautious where I'm like, okay, like there's still supply, there's still real willing sellers, demand's not exceeding it. But if you kind of zoom out and you're taking a look at volume, we've got a big old spike in volume here relative to the rest of this.
Right.
Wish I had like a oscillator, an indicator that could tell me like the median average. But I mean, if you draw like this over it, let's just say we're starting from here, this is probably the median average up until we get to the 13th. Like if the 20th is the end of this, like at the end of the price,
Yeah.
let's do this. So if we're measuring from the start of here, and this is the end, right here is, I have to do a different tool. Sorry, I'm slightly OCD about my charts. Don't get on me. There. So if we're taking a look at like what the average is, let's just say the average is here because we have some gaps, we got some wicks. We'll just call it the average.
Right.
Here we have above average price action, and you want to see that at the lows while price is turning up because this is showing increased demand for this specific value at this specific price of this specific stock. So when we start seeing above average volume kicking in and price action starts looking real bullish, meaning we're seeing higher lows. So this is the low. This little zone right here is the next low. This is above this low. These are higher lows. And when we start seeing higher highs, this was one high, this is another high, and that is a third high. We're seeing a nice staircase on both sides. We got this leg up, we've got this sideways leg here. Oh, you know what I'm getting at.
Yeah, yeah.
The lows are continuously moving up, the highs are getting higher, and volume this looks like shit. You
I
see
know what
that
you're doing.
volume
Yeah.
being sustainable. I'm just gonna go crazy if I see all that. But when we hit like a price pivot like we're hitting now and volume kicks up, you want to see that staircase start printing. So this is a staircase moving up, and that is bullish. This is very bullish. We still need to break out of this range and get out of this bearish territory for it to be a larger bullish view versus just a intermediate dead cat bounce that didn't have a whole lot of follow through.
Now I always hear the term dead cat bounce, but I never like really actually looked into what that is. So that's basically just saying that like it's a one more pump before it dumps again.
This is a dead cat bounce. We fell, we popped, volume kind of fell off, so we just fell off. Like it's an imbalance of buyers and sellers. Like there's
Mm.
not enough real willing buyers stepping up to the plate, so demand is low. And when we hit a supply zone, if real willing buyers aren't increasing as price action's moving up, we are becoming more and more susceptible to turning at supply zones, like we did here. I mean, like volume was slowly staircasing down, and then when we tagged that supply zone, I mean, we cranked into it. Then look at the next few days. Price action just slowly tapered off. So when we react to that supply zone, like this doesn't look bullish leading into the supply move. Like if we test it again, we're probably going to fail if we don't see an increase in volume.
Gotcha.
Hmm.
Now, as far as like Sol compared to other chains, when you look at last year, how Sol was kind of moving the way um, compared to like BTC and ETH. I think it was on. I forgot what run it was. That like big run right there. I forgot when the month was, but
So
do you
this
feel
is Sol minus BTC. So this is Sol in comparison to Bitcoin. So when we were having that bullish run up, you see that this is 0.0 all the way up here. I won't get it on the dot. Arrow. So this is where if we get to 0.0, that means Sol is worth Bitcoin. Do I have I think I need to do BTC minus Sol, but you get what I'm saying. I'm comparing the two charts in a one graph. So when BTC was having its big run up, the inversion of them was actually going down. But while Bitcoin has been trickling down and down, I mean, Sol's been having kind of a bullish divergence against it. Because when we just look at Sol on its own, oh my God, I have so much stuff on here. Like just on this daily range, where when we fell, we didn't fall that much. But if you look at BTC, it's like we fell off a fucking cliff.
right?
Like we just cliff dove. So Sol has stronger relative strength in comparison to Bitcoin, meaning the market is getting a little bit wiser of utility and tools and actual like blockchain technology versus just a cryptocurrency. So the market is starting to flip towards blockchain versus crypto, which is
So
a big, 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 big difference.
what you're saying is Sol's gonna flip BTC basically.
I'm not saying that, but I'm saying blockchain is going to flip crypto 100%.
Oh yeah, definitely.
Like there's no if and or buts around that.
Now, do you feel confidently that Sol will beat the market cap of ETH? Not like
Probably
in
not, because you have to think of like there's certain coins, there's certain blockchains that just have a strong cult following. And if that cult following has more money than the real willing buyers in the other blockchain, it's still going to be superior. Like ETH has a massive following. Like
yeah
whether it's like celebrities that have way more money than any of us. So ETH has a higher net worth following versus Sol. So until that crowd starts to get in here more and more, Sol's never going to flip ETH.
we
Like
got
it's a
Shaq and Steve Harvey.
yeah, but Shaq gives money to everybody. Shaq will walk into a Walmart and
I
see
know
a mom second guessing buying a PlayStation, and he's like,
I
"Let me
got
take
you.
care of that." Zach, Shaq is just a human we don't deserve, and so he's
Can I
gonna jump on every bandwagon that needs help.
can I intervene? Another thing you got
Of
to be
course you
aware of
can.
with Ethereum is their success long term relies on their Ethereum 2.0 release, and the reason for it taking so long is it's because it has taken so long. It's got so much pressure on it now that the point where it has to be perfect. It
Oh
can't
yeah,
be. It
the
can't be buggy.
expectations don't meet demand. We're gonna have a big supply shock in a negative way.
Yeah.
We'll be running
The
for the exit.
so if Ethereum 2.0 doesn't exceed expectations and some, which is very hard for it to do,
Sol's market
uh,
cap will crank. That's just my
for
opinion.
sure. All the investors that are bagging on Ethereum 2.0 being the next big thing, it's going to change the whole
It's going to change the
space.
whole market space because ETH is
Basically,
the blockchain leader. If it
if it's
fails,
not perfect, yeah,
mhm,
it's going to be a very very bad day to be an Ethereum holder.
I don't see
Which
even
ETH
is
just the
2.0
holder,
doing good
I don't
personally.
either. That's why I'm not heavily sized into crypto at the moment. It's like my most speculative investment, but I still love it. I love its utility. I love the idea of it, but there's still a lot to be desired.
Yeah, and it's still such early days. People don't forget it's so early, and I think they're expecting so much from Ethereum, and they just can't. They just can't. Um, they just can't meet the demands of what the holders are
Demanding.
asking of. Which yeah, so I think they're in for a bit of a surprise. Um,
And and it's all speculative until we actually see the writing
for
on the wall.
sure. Yeah. And sometimes when there's so much hype about an announcement, it's so easy to find yourself being underwhelmed.
I like
If you're
that.
waiting and waiting and waiting, unless they could give you $1 million in your hand, and someone will say, "Why didn't you give us $2 million? You made us wait so long." Blah blah blah. You're never going to satisfy everyone, and the longer they wait, the more and more people are going to be dissatisfied. So that's just my take on it.
Oh no, I 100% agree. Um, I just got a text from a realtor I need to give a call back to. I told them I'd be giving them a call around 6:30, so I do need to wrap this up because business is a calling and I have to answer because I'm a man of my word. But I'm happy to hop and chat with you guys afterwards and kind of elaborate, go over anything you guys might be curious about. But this will conclude today's session. I hope y'all found it valuable, enjoyable, fun. This is recorded, so we will post it in our channels later on once we kind of clean it up and edit it. But I hope you guys had a good time.
Hell
Got
yeah,
anything
thank
that
you, my
Thanks so
y'all
friend.
want
much.
to add on to it? Hit me up in the chats.
Appreciate
Thank you,
it.
brother.
Thank
I
Have a
got
good
you
one, my
guys.
friend.
Oh, you all as well. Much
Stay
love.
safe.
Yeah,
See ya.
you guys as well.
Right.
Watch out for your health. Cheers, guys.
See ya.